Welcome to Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors. Today we are speaking to the fabulous Dawn Fouhy from Future Proof Property Advisory. She's a buyer's agent based in Melbourne, and we have a chat to her about her past life as an ICU nurse and how that might translate to the buyer's agency side of things. But we have the opportunity to speak to her about Melbourne and where she sees the potential in that location. And of course, after Perth, the secret is definitely out in terms of the growth of that market. We chat to her about where she sees might be next. A pretty broad ranging set of topics we discuss with Dawn, but some awesome content, and I'm sure you're going to get something out of it. Here's Dawn. Dawn Fouhy, thanks for joining me on Geared for Growth.
Thank you, Mr. Mortlock. Thanks for having me.
Now, let's start with the elephant in the room. Your accent sounds funny. Catch us up to date.
Yes, I'm not from around here. I am Irish, shocker, an Irish nurse living in Australia, a rarity, if you will.
And that's where there's another fork in the road, because you said nurse, but I'm not interviewing you for the latest and greatest in nursing, although that sounds like a great podcast that maybe I'll do in my twilight years. But you're a buyer's agent, but coming from that health background, is that just a kind of a weird schism, or was there a path that sort of connected those two worlds together for you?
For sure. So I am an intensive care unit nurse, and now, we're looking at avoiding those markets that need life support. So my partner and I were always, it's like that. It's never been heard before, the story of we'd capped out in our borrowing capacity, and there's only, nursing isn't really the most a career where you can really grow wealth. And then we wanted to pivot, and property was our passion, and then it became our career. So we feel very lucky to do what we do.
Now, talking about markets on life support, you're based in Melbourne. Melbourne we've been picking on for a while, because there's no arguing that if you follow the CoreLogic monthly updates, it's always kind of been, as long as I can remember, Sydney's first, Canberra's second for some weird reason, because everyone gets paid too much there, unlike nursing, and then third is Melbourne. But Melbourne is mid-pack. So is that market on life support, or have we just unplugged it? It's breathing on its own, and it's actually going to spring out of bed and win the Olympic 100 meters. This metaphor has gotten weirder and weirder as it went on.
This is amazing. I guess certain parts of Melbourne are probably entering the breakdancing portion of the Olympics. There's not much signs of life on the ground, but there is a lot of stock on market, rising days on market. So people have to remember that Melbourne is huge geographically, and many different LGAs and building approvals and demographics. So it's not to be painted with the same brush. Yes, it's very early to be investing in Melbourne, but there's certainly opportunities in certain suburbs where stock is falling. So you have to be very careful when you're coming in early into a market like this.
Yeah, if you look at Victoria, it's actually doing better than most other states for building approvals. When it comes to population data, it's in second place of all the states, just after Perth. So there's a few different things going on there. When we're talking about investing across the country, such as you do, everyone's now talking about what's the next Perth, right? Because Perth, I mean, I don't think I can remember seeing a market as strong as Perth. The numbers have come out again, and it's done 2% month on month, and it's been doing that for, I don't know, about 6 months now. Annualized rate of growth, approaching 25, 26%, which is absolutely bananas. And I'm sure your phone's going hot for people saying, Dawn, I'm worried about Perth being at the peak, or I've already bought in Perth, but I want those exact results replicable somewhere else. What do you say to those people?
So I really focus on it's not about the location, and we really try and deviate away from this rhetoric. And I don't know where it's come from of, you need 10 properties and 100K passive, and it's like this holy grail that everybody's searching for. But we focus less on the location, but more so on where is affordable for your budget and your risk appetite. So
Mm.
every investor is different, and it's not like what we don't want to do is follow the herd. So much like we were, buying in Perth 2 years ago, um, you don't want to be that person like going gung ho into Townsville now and just buying anywhere, or into Rockhampton where it's already had a truck ton of growth. You really need to be smart with where you park your money, especially as your wages are definitely not growing in line as to what house prices are. So it's just about helping people understand it's not about the next Perth. It's about you finding which market is affordable for the demographic that lives there, and which market has reducing supply and high demand. And first home buyers will often be the first key metric that we look at and we follow, especially here in Melbourne.
That's an interesting one. So how do you get the data on where first home buyers are buying, with the idea that that's a market that it'd be worthwhile tipping into as an investor?
Well, that's where it comes to, investing is a science and an art. So the data will only tell you so much.
Mhm.
The art of it is the relationships that you have with agents. So you're chatting to agents, and I want to see suburbs where there's 10 owner occupiers vying for a property, or suburbs where they have gotten priced out of one area and then they've moved to the next area. And historically, that area might have, poor reputation as regards, socioeconomics. And I'll be transparent. I'm talking about areas like Frankston North, Carrum Downs, Skye. I see a lot of potential in those areas because of the activity I'm seeing, the affordability, and just the juxtaposition of, so for people who don't know, Frankston South is, you can get houses for between 1.5 to 2 million. And you have Frankston North, which the average kind of price is between 550 to 600. Not many duplexes, all houses on about 600 square meters. So it's primed for that growth. And what we're seeing is a lot of first home buyer activity in that area.
When I first went to Frankston, I didn't really know anything about it. It was actually the swim start for the Melbourne Ironman, which was a new race, and I went especially to go and watch it. And people said, "Oh, you're going to Frankston? Oh, roll up your windows there." And I couldn't quite understand, because it's like a beach suburb that's really quite beautiful. But is it one of those kind of gentrifying, sort of ugly duckling suburbs for everything that's not sort of waterfront?
For sure. And it's you've got Frankston North just inland, and then you've Got Seaford, which is by the water, which is very, very affordable as well. And it's like every area has a reputation at some point. We're not talking about an area that's as has a poor reputation as, let's say, your Armadales in Perth, because again, it isn't as affordable.
Mm.
And yes, it's like, a 45 minutes drive to the CBD, but people need to remember in Melbourne, we commute. So a lot of people are on that hybrid work from home model. Commuting 1 hour each way a day is the norm here. We have the train systems to support that, as well as people drive into work. So even when you are coming to invest in Melbourne, you have to realize what the local demographic does and what the behavior is of the people who live here. And also the townhouse market is very undervalued in Melbourne, and a lot of first home buyers will buy townhouses, and they'll raise their families in there because they're priced out of houses on land.
Mm. You raised a couple of interesting points about it not being about the hotspot. It's there are other things at play, like the demographics, the local demand, who's buying, and why that makes a difference. But the other point that you raised was, well, it depends on you, right? I think as a national conversation about property investing, we're definitely getting focused on the hotspot rather than, okay, well, what do you have the capacity to borrow? What is the bank perhaps either mandating your yield to be, or what can you comfortably work with? And how does this property fit within your existing portfolio? If you have one, you might have lots of cashies and you've got an opportunity to chase the capital, or vice versa. How often do you see that with people coming and chatting to you, that it's the hotspot first and the strategy second?
Correct. It's often are we too late for Perth? Are we too late for Townsville? And then it's about me redirecting the conversation. Well, what worries you about investing? You know, what you and your family like to do for fun. So, you know, we're not in a cost of living crisis. We're in a cost of lifestyle crisis. And, you know, um, my job and what I focus on is that their lifestyle isn't impacted by investing in, you know, assets. I just, because a lot of people are like, you know, mom and dad investors, or even young people starting off rent investing. And often I think people get stuck on one property, not because they've just picked a lemon, but also just because of the mental power that you need to push through with investing and know it's going to cost you money. So a lot of the time for us, it's around picking a property that will help people sleep at night as much as we can control. And I do a lot around mindset work with our clients around trying not to focus on things you can't control, like land tax and the government, and avoiding the tinfoil hat wearers who say the market's going to drop 50% and they're waiting to dive in for that. I said those people will always be the loudest, but I said those people will still be in the same position they're in while you're 3 properties ahead in the next 5 years. So don't stress about those. The market's going to crash. Like, yeah, sure.
If I was a buyer's agent, I would love that they're, as part of the sign-on form, is an agreement that they won't turn on their television or listen to the radio or read anything for the course of the thing, because I'm assuming that there's just so much noise that's what is really kind of playing out in their heads. It's like, well, you know, is it going to crash, or am I too late? Am I too late? You know, that's a really interesting one.
Yeah, and that's normal to feel like that. And I think that's why investors move in herds and packs, because as humans, people like the security of, well, you know, my neighbor bought here, it must be good, or I heard a certain person was buying here. But, you know, that pack mentality becomes self-fulfilling of a market, you know, perhaps overperforming at a certain point, and then when it corrects, you want to make sure that you've left that market by then. And that brings it, I suppose, to that interesting point of what we really focus on is timing markets. And you don't necessarily have to hold forever, especially if you're an employee, like as in if you're a PAYG worker, your borrowing capacity is going to be capped. So you need to be really smart about moving your money around. Gone are the days of just holding your asset forever if you want to grow wealth, I think.
Yeah. There's a good Mark Twain quote that's something along the lines of, for God to create man was a splendid thing, but to create the sheep was a tautology. As if to say, we basically operate the same way. And you've got a real interesting insight into the difference between being early and being late. And I think that is kind of about the herd mentality and trying to time these markets. Would you share that with us?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, so I think it's always better to be 5 minutes early to a market than 15 minutes late. I remember when we were investing in Perth personally, and you know, our friends were horrified, and everyone, and they were like, it's just some mining town. Like, what do you mean? But what we really saw was the affordability for the local demographic, no to limited new bills, and just just how cheap it was, and the yields. So for because if you're buying in a hotspot, right, and you're buying, especially if you're buying on market, potentially you are going to overpay. And so you're not going to make that money on the year in, on the way in. And you might actually affect how much growth you're going to get in the year, because it's often, that herd driven by FOMO. It's just people trying to win. So, and often I find that people who come to us might have made that mistake because they got sick of looking, or they kept missing out. But yeah, they just make a mistake of overpaying or buying in the one suburb in the area that's already grown by 80%. So yeah.
I kind of think it's you have to pay for the green shoots, right? Because once you see the green shoots of a market, or let's say confirmation that it is moving in a positive manner, you're talking about data that existed 3 months ago that is only just reporting to you, right? Because if it's based on settlements and you got the value of generals delay and the core logic stuff, you're always a little bit behind the eight ball. So if you're waiting to the point to confirm where that market has moved, if it say grows by 10%, there might only be 6 or 7 less left of that growth. Is that a similar way of making the same point, do you think?
Correct. And I think it's also important to note that if you are investing now, it is going to cost you money. I think people had skewed, maybe they just started investing in COVID and they thought that everything was going to give you $5,000 a year and it was all going to grow by 20% in 1 year and investing costs you nothing. But historically, where we're at now is kind of the way it is. Investing in a property costs you to hold about $250 a week, and you can't control land tax or governments. And I think what people fail to realize is when we actually looked at the holding costs of property in regional Queensland versus the land tax and lesser insurances in Melbourne, they came out at the same holding costs. Yes, the entry costs are higher because Melbourne stamp duty is double, but I think people forget to realize that any government can change its policy at any time, and Melbourne's lower threshold is temporary. If you go onto any of their government websites, it's the threshold has been lowered to 50,000 temporarily. And it only takes a minute change for sentiment to shift in a market one way or another. And I know I would prefer to be holding in Melbourne when that sentiment shifts, because when the interest rate drops and, whatever else happens, if there is a change in government, Melbourne grows quite quickly because people here spend what they can borrow.
Yeah, and I mean the land tax in Queensland was repealed ultimately. It was legislated, it didn't come into effect. But if that was to happen in Victoria, I think that would be a huge change. And you make a good point about, once you balance, say, the land tax and then you compare it to regional Queensland, it comes out similar, but it seems there's a disproportionate response to a negative announcement. Like, I always think about the carrot and the stick. You look at the difference between Perth and Victoria. Perth sort of said, if you take your Airbnb and put it on the long-term market, we'll give you $10,000. Victoria said, we're going to tax you 7.5%. And I think when those negative things happen, people avoid them. It's a bit like, I want to invest in property because I'm paying too much tax. It's like, well, do you care if it grows in value? You just hate the tax, right? Do you think that's at play in our psychology?
For sure. And I think that, again, people listen to the loud negative rhetoric more than actually dialing in. So all I hear is opportunity, because they even said in August it was the highest number of listings in Melbourne, and investors are leaving by the truckload. All I'm seeing then is vacancy rates dropping and rents rising because people are leaving. But it's just so counterintuitive that people are like, no, I mustn't invest there. I must go to where everybody else is, and overpay and not really think laterally that you're talking about one of the most livable cities in the world. Yes, we have a massive COVID hangover, and no amount of Baraka is helping us with that. But like, I've lived in Melbourne for 15 years. I came to Australia expecting the home and away lifestyle, so I don't know how I've ended up here.
Yeah.
Don't get me wrong, every winter we're like, we need to move to Queensland, but then our summers here are fantastic, and global warming is a thing. So the next 15 to 20 years for Melbourne is looking very promising in my opinion.
Yes, very positive for the beachside residents. Not so positive for, say, the Pacific Islands, but
No.
that's just where your surname is borrowed from, not your location. So
Correct.
you'll be fine. Now, you mentioned rent vesting before, and
Yeah.
you cite buying a principal place of residence as something that is a mistake that you've made. What are you getting at there?
Because if I knew what I know now, and hindsight is always, a great thing. We could have, ridden so many booms along the way. So we've actually transitioned to a rent vesting strategy now. So we have a 4-year-old son. We're living in a townhouse in Melbourne, but we have, done the classic mistake of we've rented out that townhouse, but the purpose is to rent it out until Melbourne does make a resurgence, and then we'll sell that CGT free. But we've started renting here in Melbourne because it's so much cheaper, and when we did the maths and we put that deposit that we would have put towards a PPOR of 1.5 to 2 million, we were then able to buy 3 investments for that. So it just made more sense for us with the leverage. So yeah, I'm a big advocate of rent vesting.
The one area that I think there's an X factor for PPOR is the CGT exemption, right? But that has to be balanced with the fact that, okay, well, the intention is not purely investment, but with an investor brain, I never look at a PPOR without looking at, is this going to grow in time, right? Because you're tying up a huge amount of capital, and I'm guessing that the banks are looking at you much more favorably renting for what I assume is a much cheaper weekly amount than what your mortgage repayments would be.
Yeah, it's half. And also I think a lot of people feel like, their memory dividend from, renting somewhere versus owning it might be less, but it hasn't affected our happiness or not feeling like this is our house with our son, because, home to us is where we are as a family, that the house is the bricks and mortar. I think there's so much emphasis now, based on kind of the material things, and even, investing for us is just about us having options. It's less about passive income, because we don't want to retire. I enjoy working, and I think that, sometimes if you retire too early, it's probably a bad thing. It just gives you that sense of purpose. But again, that's a personal decision. But yeah, I think we need to move away from the holy grail of this 100K passive income. I don't even know where that's come from. Because again, that's gross passive income. You haven't factored in your property management, your fees, your insurances, your, hot water system breaking. So just focus on enjoying yourself and not collecting 10 properties for the sake of it.
Yeah. But I mean, all the books, Dawn, it's like 30 before 30 or 10 in 10. You've got to tie it in this nice little bow. Otherwise, are you even successful?
Yeah, but marketing is, a very powerful tool, but you can be just as successful by, pigeon pairing $1 million Sunshine Coast asset with a cheaper, regional asset, selling the regional asset once the market peaks, pay down the, Sunshine Coast or Gold Coast property, and you can still end up with a $2 million, portfolio and have one property.
Great strategy, rubbish book title.
Correct.
That's
pigeon pairing. It sounds a bit like, but that's one of our favorite strategies, because you can have both, because obviously it's, since the beginning of time, not like blue chip versus regional, boring, but I think there's a place for both strategies.
Speaking of strategies, I think by the time we go to air, this might be a couple of episodes ago, but I spoke to an accountant who has made a name for himself investing in property and quite heavily in his super fund, and basically said that capital growth is pointless. It's all yield, 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 cash, cash, cash. You're a bit of a contrarian to that view. Where do you land on that? I mean, this is one of those age-old things, and I've probably asked 1,000 people the similar sort of question. But what's your take on that?
Like, I get, like, equity does not pay the bills, like, 100%. Like, you can't go out and, pay for a meal with equity or go on a nice holiday. Well, you can, but that would be silly. Don't do that.
It's not financial advice.
Yes, no, this is not financial advice. So cash flow has a place, yes, but you need a capital growth base. So even like I was talking to someone the other day, and they bought a property in South Headland for, I think it was 635,000 back in 2012. That hasn't grown. So it hasn't grown in 12 years, but it is bringing in $1,700 a week in rent.
Mm-hmm.
So yes, it's a cash cow, but you've had no capital growth, and it's the opportunity cost of holding something just for cash flow. I just don't get it. I think you can have a balanced approach and have both. I think you can look at making properties placed well, make the holding costs easier by putting a granny flat on. There's other levers you can pull, but I think capital growth needs to be your focus.
I was recording another episode this morning, different show, and we were talking about when capital growth is sort of like adding another person to the household, going out and having a job and bringing in a salary. That's the way that I kind of think of it. It's exciting when your portfolio starts making more money than you do, and it does it while you're sleeping, and you're out there, working 50, 60 hours a week trying to do the same thing. That sounds like that's the power in my mind. How do you view it? Is it more of a stepping stone to the next one, or is it just about the net asset base getting to a point while you're working and then start looking at the cash flow? Because that's when you get that kind of passive stuff that we were talking about.
Correct. So I think that initially, for the average investor, it can be very overwhelming to even think about getting one property, let alone four, and trying to manage that. So for us, in relation to the capital growth piece, a lot of people that we work with might have the deposit for the first one, and they're really relying on this property to grow to be able to leverage into the next one. So I think the power of capital growth is that leverage you can have from equity, but we always have in the back of our mind debt reduction strategies along the way, or as I said, granny flats are turning a 3-bedroom property into a 4-bedroom property, so people can have that kind of instant equity. I think that you can't just look at it as capital growth versus cash flow. I think it has to be balanced, because yield will help you hold the portfolio through any sort of economic turbulence, but I think ultimately we just want an asset that is going to grow and perform and give you confidence in investing, because I'd prefer to be 100k growth a year in equity than 2k a year positive in cash flow, to be honest.
Yeah, it's pretty stark when you put it in those terms. Dawn, we've tackled some of the big issues. I think we've hopefully sort of put some blinkers on the investors to not be staring around at all the different moving parts. For people that maybe are a little bit paralyzed, they're a little bit scared, they want to dip their toe in the water, what's your best sort of starting advice for them?
I think that it is all about where they, get their knowledge from. I think the problem now with social media is there's so many conflicting opinions, and, everybody's an expert. So I focus on learning from people who've gotten to where you want to go. I think that's a great place to start, a really good broker. And I think that if you're thinking about investing, focus on affordability, and focus on properties that will really help you, sleep at night, just like solid brick homes and as much land as you can afford in areas where people want to live, where the economies are vibrant enough. So when we're looking at investing, we don't personally or professionally buy in Gladstone, or areas where we feel personally there is just more of a risk in the economy. We don't just want short to medium term growth for our investors. We want sustained growth. So we like to look at things in a helicopter view, and we want to look at it from a person who might say, oh, look, I just want to hold this forever. So again, it's all down to people's risk appetites.
I think that's tremendous advice, and anyone that's listening to this will be a little bit closer to that proper path. So thank you, Dawn, for sharing all of your insights today. It's been a pleasure.
Thank you, and I just hope people took some value from it. And investing isn't scary when you just listen to the right people.
Beautiful. Well, thank you for listening, and cheers, Dawn.
Thanks, Mike.